Applied Digital Corp, ticker APLD, is currently trading at $33.05, which is a significant drop of 7.94% for the day. The stock is getting hammered in the early hours of the trading session, and while many will point to general market weakness or a tech sector pullback, the real story here is far more specific and cuts much deeper. The price action today isn't just random noise. It's the market's visceral reaction to the growing tension between the company's grand AI ambitions and the brutal, capital-intensive reality of making those ambitions profitable. Everyone sees the headlines about Applied Digital building next-generation data centers for the artificial intelligence industry, and the expectation has been that this company is a primary beneficiary, a surefire picks and shovels play on one of the biggest technological shifts of our lifetime. The common belief is that as long as AI grows, so will APLD, but that narrative is dangerously simplistic, and the market is beginning to question it. The reality being priced in today is one of massive capital expenditures, potential shareholder dilution to fund that growth, and intense competition from established giants who won't give up market share without a fight. The drop you see on the screen is the market recalibrating its excitement with a heavy dose of operational and financial reality. Let's break down today's trading action more closely. The stock opened at $35.20, tried to push to a high of $35.36, and was then met with a wall of selling pressure that has driven it down to a low of $32.87. We are currently trading very close to that session low, which indicates that sellers are firmly in control and buyers have not yet found a price level they are comfortable defending. The volume is notably higher than average, suggesting this isn't just a few institutions trimming their positions. This is a high-conviction move downwards. This kind of price action often follows a period where a stock's story outpaces its fundamentals. For weeks, the narrative has been about Applied Digital's pivot from a volatile crypto hosting business to a more stable and high-growth HPC and AI infrastructure provider. They've announced major contracts and have been aggressively building out capacity. The expectation was that these announcements would provide a solid floor for the stock price. The reality is that the market is now looking past the announcements and asking tougher questions. How profitable are these new contracts? What are the margins? More importantly, how much more cash will they need to burn through to complete their ambitious data center build-outs in North Dakota and Texas? These facilities cost hundreds of millions of dollars, and that money has to come from somewhere, either through debt, which is expensive in this interest rate environment, or through selling more stock, which dilutes existing shareholders. Today's sell-off is a reflection of that fear. This brings us to a critical topic that many retail investors overlook: the activity of short sellers. Applied Digital has become a significant target for funds betting against the stock. The current short interest in APLD is sitting at a very elevated level, well above what you would see for a typical company. We're talking about a significant percentage of the company's entire float being sold short. This isn't just a minor sentiment indicator, it's a direct financial bet by sophisticated institutions that the stock price is headed lower. The core of their thesis isn't that AI is a fad. Instead, the short thesis likely centers on the company's financial structure. They are likely pointing to Applied Digital's balance sheet, its cash burn rate, and the risk of future equity offerings that could put immense pressure on the share price. The cost to borrow shares of APLD has also been creeping up, a clear sign that demand from short sellers is high. When borrow rates spike, it means it's getting more expensive for shorts to maintain their positions, but it also shows their conviction. For retail investors, it's essential to know how to track this. You can find short interest data on platforms like Fintel or through many retail brokerage accounts, often updated twice a month. Watching the days to cover ratio is also important. It tells you how many days of average trading volume it would take for all the short sellers to buy back their shares. A high days to cover ratio can sometimes set the stage for a short squeeze, but it's a dangerous game to play. What's your take on the rising short interest? Smart money or manipulation? The smart way to use this information is not to blindly bet on a squeeze, but to understand the bear case. Why are these funds so convinced? It forces you to look at the risks more critically. The reality is that Applied Digital is in a race against time. They need to get their data centers fully operational and generating cash flow before their funding options become too dilutive or too expensive. The expectation is a smooth ramp-up, but the reality of construction and supply chains often involve delays and cost overruns. A short seller sees a potential delay as a trigger for a stock collapse, while a long-term bull sees it as a temporary hiccup. Understanding both sides is what separates informed investing from speculation. So when you see a stock like this fall hard on a day with no apparent company-specific news, one of the first things to investigate is whether it's related to sector-wide selling or if it's a continuation of pressure from an underlying and significant short position that is exploiting market weakness. So what exactly does Applied Digital do? At its core, it designs, builds, and operates next-generation data centers. The company started by providing hosting for Bitcoin miners, which was a profitable but extremely volatile business tied to the price of cryptocurrency. Recognizing the need for a more stable revenue model, management made a strategic pivot towards providing infrastructure for high-performance computing, which is the kind of intense computational power needed for artificial intelligence model training, machine learning, and other data-heavy applications. Their business model is to sign long-term contracts with large-scale customers who need dedicated data center capacity. For example, they might sign a multi-year deal to provide a certain amount of megawatts of power and cooling to an AI company. This provides more predictable recurring revenue compared to the crypto market. Their key assets are their large-scale data centers, particularly the one in Jamestown, North Dakota, which benefits from a cold climate and access to cheap power, two of the biggest operational costs for any data center. The expectation is that by building these state-of-the-art facilities, they will attract blue-chip AI clients and lock in revenue for years to come. The reality is that they are competing against behemoths like Digital Realty and Equinix, who have deeper pockets, longer track records, and established relationships across the industry. Applied Digital's edge is its focus on next-generation design, specifically for the power-dense hardware used in AI, but it is still a David and Goliath scenario in many respects. Looking at recent performance, the stock's volatility is a direct map of this conflict between expectation and reality. The stock saw a massive run-up earlier as the AI narrative took hold. Every announcement of a new hosting agreement or construction milestone sent the stock soaring. However, the subsequent pullbacks have been just as severe. The reaction to their latest earnings report was a key example. While they showed strong revenue growth, the market was more focused on their net loss and cash burn. The expectation for a high-growth tech company is often just top-line growth. But the reality for an infrastructure company is that profits and cash flow eventually matter, and the market's patience is not infinite. This is where we see a divergence in investor sentiment. On forums like Reddit and X, you'll find a strong contingent of retail bulls who are focused on the long-term vision. They point to the size of the AI market and believe any short-term pain is just an opportunity to accumulate shares at a lower price. On the other side, you have institutional analysts and short sellers who are modeling the company's financials and pointing to a potential funding gap in the coming quarters. This brings us to the future outlook. What are the key catalysts and risks investors should be watching? On the positive side, the single biggest catalyst would be the announcement of a major contract with a household name in the AI space that would validate their business model and technology in a way that nothing else could. Another positive catalyst would be securing a large tranche of non-dilutive financing, such as favorable debt, which would signal to the market that they can fund their expansion without having to sell more stock at depressed prices. Finally, any earnings report that shows a faster-than-expected path to profitability or positive cash flow would cause a significant re-rating of the stock. Comment below how many shares of Applied Digital you currently hold and what your average cost is. However, the risks are just as potent. The most immediate risk is execution. Any delays in the build-out of their new data centers could be disastrous for sentiment and would give short sellers more ammunition. A second major risk is the competitive landscape. If a larger, more established player announces a major push into AI-specific data centers with aggressive pricing, it could put pressure on Applied Digital's potential margins. Finally, macroeconomic factors are a huge overhang. If interest rates remain high, the cost of capital for companies like APLD will continue to be a major headwind, limiting their ability to grow. The expectation is that the overwhelming demand for AI infrastructure will trump all these risks. The reality is that financial gravity always applies. A great business idea is not a great investment if the company cannot fund its operations and turn a profit in a reasonable time frame. In summary, the sharp decline in Applied Digital stock today is not a simple market fluctuation. It's a symptom of a much larger battle being waged. It's the battle between a powerful, forward-looking narrative about the future of artificial intelligence and the cold, hard numbers on a balance sheet.
The expectation is that APLD is selling the essential tools for the new gold rush. The reality is that building those tools is incredibly expensive, fraught with risk, and attracts immense competition and scrutiny from those who are betting it will fail. The real test is whether the operational reality can catch up to the market's initial lofty expectations before investor patience and the company's cash runs out.